Hello again, everyone, and welcome to the Options Mentor. We have a big week coming up. We're finally going to get to that September rate announcement from the Fed. It looks like they're probably going to do a quarter point. That's what most of the market expects. Of course, there's some holdouts out there hoping for a 50 bip cut. I don't see that happening. I think it'll be a quarter. And I think the market, if it gets its quarter, it's a very likely chance it could react positively to that, maybe even go to new all-time highs. But if that is a thing that you think, then I'm going to show you a couple of speculatory strategies. One that doesn't matter which way it goes, as long as it goes somewhere in a large way. And I'll show you another speculative strategy for this week where you can pick the direction, whether you think it's going up or down. I'm not sure what to think. I would lean it would probably go up, but I don't know. So I'll tell you this, never going to happen. But if they did go 50 bips, we would rally hard. But I think it'll be a quarter. So we'll see what happens. But anyway, one method of playing this, playing it for a larger move. If we look here, this is SPY. I'm going to show both of these trades in SPY today. And if we look here, we're kind of at the top of the range. The all-time high is 565. We're at 562. And then this news will come out Wednesday afternoon. Now, very important here. Listen up here. This first trade, a back ratio, you would not want to put on until Tuesday afternoon late or Wednesday morning, because you don't want the market to move around too much before this event, when you want to get this on as close to the event as you can. And then if it really moves off of that, you get to take advantage of it. So the idea here is I would be using the October 4th expiration. I like to be 12 to 18 days out with these because they're fairly sensitive to time decay. You don't want to be sooner, and you don't need to go out later. It starts to decrease your credit, and overall, the trade doesn't work in your favor as fast. So if we use the October 4th expiration, I believe it'll be about between 12, 13 days out if you put it on Tuesday. And what I model here is the market closed at 561, the SPY that is, on Friday. So what I did is I went up to 565, sold 2 calls, and then up to 570 and bought 3 calls. Now this, remember, SPY is roughly 1/10 of the SPX. So if you did this trade in SPX, it'd be 50 points wide. It would be $10,000 in margin. You can see here, it's 5 points wide and only $1,000 in margin, but you do want to use that sell 2 buy 3 ratio. And you want a graph that looks like this. So then Wednesday afternoon, maybe they do the cut, maybe the market goes crazy, loves it. You could probably take this to Thursday, but that would be the latest you want to get out. But if it runs up, maybe goes to all-time highs, you just cash out. Runs down, you should also be making money too. Volatility will help you. And it doesn't matter how far down it goes because you put this on at a credit. Now, it's a fairly inexpensive trade if you do it this way. It would cost you $1,000 less your credit, so about $875. Not the cheapest, not by far not the most expensive. Like I said, if you did this in SPX, it'd be $8,000. But if you want to do it a little bigger, I would suggest if you've never done it, you just put it on paper, by the way, so you can see how it works. But you can also just double the size of it by doing the next 2 by 3 up. So sell 4, buy 6. Now that's going to cost you $2,000. You'll get twice this $1.36 credit. So this trade would be, what is that, about a $1,740 trade, because you get around 270, 260 less off the 2,000 in margin in the same scenario. But you will have to figure out which strikes to use on Tuesday afternoon or even Wednesday morning when you decide to put this on. I do like to be 5 points wide, selling 2 of the near, selling or buying 3 of the further out. And if you're anywhere near a 5 strike, I'd probably go to that and look at it. Or maybe you're nearer to a 0 strike. So let's say by Tuesday afternoon, we're at, instead of being at 561, maybe we're at 556, a little bit lower. So then you might use the 560, 565. So just keep that in mind. So that's one idea. Oh, and by the way, I have a course coming up here, probably be out the last week or weekend of the month on back ratios and directional flies, which I'm about to show you one of those now. So let's suppose you think we're going to all-time highs, maybe go up to 570. If you look at the expected move in SPY by the 20th, right there it is, the market maker expected move plus or minus $10.42. So somewhere in that area, where it'd be a little over an $8 move if you went to 570. However, we have room on the other side with this particular setup and on the near side. So you put this trade on, and you could put this one on earlier. I mean, you could put this on Monday, but you might also want to wait till Tuesday on this and get a little better idea of where the SPY will be by then. And this one you'll do for this week's expiration, the Friday, because a fly works best if it's in the tent right around or right at expiration. So what we'd like to do is put this on whenever, Tuesday, tomorrow, and then if the SPY ran up into here, you could have a pretty good reward on Thursday afternoon or Friday morning. You may just want to take it Thursday. Don't bother with the aggravation of expiration day, but if it's small and you want to take those chances, then you can do that. Now, remember with a trade like this, if you decided to do it live, everything you could put this on tomorrow afternoon, but everything you have in it could easily be lost quickly. Because just imagine you put it on, we were right here Tuesday afternoon, the Fed comes out Wednesday and disappoints the market. Then we're going to go down. This trade will be worthless. So anything you have in it will be gone or nearly all gone. So be very careful with that. Because when you do directional flies, if you're wrong and the market goes the other way pretty firmly, poof, right? That's everything's gone. So this is a spec play. Your spec play should always be very small, not the milk money, just money that you care to risk on an idea, like a lottery ticket. This isn't something, that this isn't long-term investing or anything. You got to be careful with these. These are just kind of a one-time spec play, just picking a direction. If you don't have it right, you don't have it right. Or as in the back ratio, you just want it to move big in one direction or another. If it lays here, you'll be down a little bit. This close the trade, time decay, volatility dropping, that will affect it, and you'll just want to get out. But you shouldn't have a big loser if you took this off Wednesday afternoon if nothing happened. You'd be at a loss if it hung around here, but it wouldn't be that much relatively. And of course, if it takes off, you just take the money and run. There's no set percentage on either of these trades for profit goal, because we just don't know when and how it's going to do whatever it does. And in a trade like this, sometimes you can't make 10% on the bottom. So I wouldn't want to give you a goal like that. So the goal in this is, let's make money and get out. Particularly if it goes on the upside, we want to get out very quickly because it is long vega and it'll shrink down and this will dissipate. So there's a couple of ideas if you want to do some spec into the Fed rate announcement this Wednesday afternoon. That'll come out at 2 Eastern. Please make sure you subscribe to the video, like the video. Check out all my links in the video description so you can come over to arimer.com every day and be with me and look at trades like this, and definitely look at them more in depth, as well as many other trades. So thanks for being here. Have a great trading week. Let's see what the Fed does to us. Have a good one. Bye-bye.